With the cannabis industry, you have many different options of where you want to place yourself within the industry. You can be a cultivator, a manufacturer, a distributor, or even a retailer. But there's a business model called vertical integration that encompasses all these aspects of the supply chain. So in this video, we're going to talk about what vertical integration is, the benefits of vertical integration, then conversely, specialization benefits, as well as talking about and analyzing the profitability of a vertically integrated cannabis-based business. Now, if you have any questions about cannabis business accounting or financial analysis for your cannabis-based business, then please reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. Let's hop right into the presentation. So today's topic is understanding and analyzing vertically integrated cannabis-based businesses, and this presentation is brought to you by Green Growth CPAs. Now, with cannabis business licensing, you have many options such as cultivation, manufacturing and processing, distribution, and even retail. But one business model that doesn't get covered as much, though, is actually vertical integration, which means operating a business in every vertical of the cannabis industry. So in this video, we're going to explore vertical integration for cannabis-based businesses, the benefits compared to specialization, and explore how to know if you're actually profitable in your vertically integrated cannabis-based business. But before we do, I need to let you know that the information contained in this presentation is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not give any personalized legal, tax, investment, or any business advice in general. So with that out of the way, let's review what we're going to cover in this video. So first, we're going to talk about vertical integration and what that actually is. Then talk about some of the benefits of vertical integration. Then conversely, what are the benefits of specialization, taking on and working in only one vertical of the cannabis industry? And then we're going to talk about the vertical integration profitability analysis. And this is going to be a 30,000 foot look at that process because it's very nuanced and very, very detailed, as you can probably understand. So first, what is vertical integration? So simply, vertical integration is a business model where a company controls a product from the creation to the distribution to the retail where they sell it to the end user. Now, you may have heard terms like farm to table or seed to sale. Essentially, you grow the cannabis, you process it, you distribute it, and you sell it to the customer all on your own without any help from another business getting any other inputs. Now, how this is actually implemented or regulated in cannabis is not consistent across all of the states. For example, in Washington state recreational market, vertical integration is prohibited, and in New Mexico's and Florida's cannabis market, it's actually required. And other states such as Colorado or Oregon, they allow vertical integration but don't mandate it. And sometimes it's not even possible to vertically integrate, especially when there are certain cities that stop licensing for certain license types such as cultivation or retail businesses, or they don't allow you to have overlapping licenses in those states, which is few and far between, but it is sometimes pushed that vertical integration is not allowed in certain areas. And understand that not everyone is in favor of vertical integration, because when vertical integration is allowed, it starts to put pressure on craft growers or small-scale businesses that serve specific niches in the industry. And if vertical integration is required, then it pushes out those who don't have enough capital to start a cannabis empire. As you will understand throughout this presentation, vertical integration is incredibly capital intensive to the tunes of millions and millions and millions of dollars. You think starting one dispensary or one grow-up is expensive? Think about starting from everything, again, seed to sale, and you have to own every part of it. It becomes very, very expensive. Now, the opposite of vertical integration is specialization, and this is where you focus on one specific vertical and be the best at just that one aspect of the supply chain. So the big question remains, or that we're going to pose, is should you vertically integrate or specialize in a certain vertical? Now, we're going to cover a 30,000 foot look at this. There are many different things and many different considerations for going vertically integrated or specializing. Biggest one is going to be your cash on hand. Can you even afford to vertically integrate? But also your skill set. If you can't keep a plant alive, a house plant alive, you probably shouldn't be a cultivator. Or if you're not good with people, maybe you shouldn't be in the retail side of operations. Or if you don't have a team member who can help you out with any of those certain aspects, maybe vertical integration is not for you, and you should specialize in what you're good at. But let's explore vertical integration, specialization, and how to analyze your vertically integrated cannabis-based business for profitability. So next, let's explore some of the benefits of vertical integration. The first one is better and cheaper products. Now, when vertical integration is working well, the consumer typically gets a higher quality, fresher, and cheaper product. But the key term here is working well, because when there are major inefficiencies in a vertically integrated cannabis business, you have waste and products can cost more to the business, which then passes that cost on to the end consumer. Now, if they don't actually pass this cost on, the company will likely run out of money or have to cut certain verticals or close up totally. So when you have inefficiencies in the business, the products end up costing more. So again, when vertical integration works well, it usually results in better and cheaper products for the end consumer. The second benefit of vertical integration is that businesses capture all the margins throughout the value chain in their business or their industry. So when you own all parts of the supply chain, you're able to control the costs along the way and dictate the final cost of those products and capture all the value created from the beginning of the product creation all the way to the end sale. Now, this can give you a more defensible business, and you're not at the mercy of what the general market will charge for the inputs of your business. For example, if flower prices rise up because of some market circumstance, maybe there's a shortage in the amount of flower and you're at the general mercy of what the market's going to give you, well, you don't have to worry about that as much when you're a vertically integrated business. You have your own supply, you create your own supply. The third benefit is that you can control the product quality from seed to sale. Now, in the cannabis industry, aside from simply creating a product, it needs to pass testing for a variety of contaminants such as pesticides, heavy metals, and many other things. And one nuance to understand is that cannabis businesses cannot test any of their products, and it must get tested by a third party. And when you purchase a product from a third party, for example, say you're buying flour to make oil because you're not vertically integrated, you typically make that sale contingent on passing testing, because you cannot trust anyone on their word that their cannabis is clean, and this can eat up precious time in creating your product. So when you own your entire supply chain, you can have a bit more peace of mind and confidence that you'll be getting a clean product, that is, if you have good practices, and that you will get consistent product for your customers to purchase, and you will get consistent ingredients to create derivative products from. So when you have that control of your supply and a clean supply, you have confidence in the products, and you can typically move faster than buying from a third party. You're not being yanked around for many various reasons. Which brings me to my next point, is having that dependable supply availability. Now, the legal and illegal cannabis industry goes through droughts in product. It's just the way the cyclical things happen and the seasonality of the way that the product is created and harvested. Now, with indoor grows, that's not that big of a problem, but it still affects when you have low production or high production in the outdoor market. Now, it's not a well-oiled business with tons of product, and when you hit one of those dry spots, non-vertically integrated businesses get left out of the market because no one will sell them product at a fair price. Or if you have to buy that product, your margins take a huge hit. So when you're vertically integrated, you always have a stream of consistent quality product that you can depend on, and you're not at the mercy of other businesses selling product to you. And if you have excess product, you can offload that to other businesses if that's permitted in your state or local jurisdiction. The next benefit of vertical integration I want to talk about is that you can be more nimble in your operations and your product offerings. Now, when you're vertically integrated, you can get access to all the information from cultivation operations to retail customer feedback, and it's data you can trust because it's from within your business. This makes it easier to capitalize on trends in consumer tastes. For example, if you see certain strains are picking up in sales, then you can give direct feedback to your cultivation team and they can plant more for the next harvest. Or maybe you start to see a trend in a new type of edible or product being sold or pitched to your retail location. You can then relay that information back to your product development team to explore these options so you don't have to pick up these items from a third-party supplier, lose margins, and then cannibalize your current product sales. And lastly, another example is when you start to see prices move earlier in the supply chain, such as price per pound going up and increasing or price per the gram of oil increasing. You can relay that info up to your retail location, who can slowly adjust prices instead of taking a big price increase, or tell them, hey, suggest these other products to customers so we can keep our margins. Understand that knowledge is power, and vertically integrated businesses have a lot of knowledge, which means they can have a lot of power within their business. Another benefit of vertical integration is having control over the product retail price. Now, when you're not vertically integrated, retailers hold a lot of leverage over your brand. This is especially true when it comes to wholesale price negotiations and terms of those payments. But one aspect to know is that it doesn't matter if they decide to carry your product. We all think that it's very hard to get into a dispensary, which it is. But a lot of dispensaries will take on a lot of product, but they don't pay you right away when they take that product on. They only pay you on product that's actually sold and will return whatever leftover product at the end of whatever term that is. So you need to understand that the retailer, make the choice, and it depends on them if they actually make your product accessible to the consumer that you're actually targeting. Understand that dispensaries price your products to customers with their markup, and it may make your product out of reach to certain customers, or they may even charge you slotting fees. So having direct access to customers is such an incredibly important aspect of the cannabis industry that you cannot overlook. So when you own your retail location, you dictate the markup and the price to the end consumer and where you show up in the array of products, on what shelf. Are you right at the front? Are you in the back? Are you somewhere where people cannot see you? Having control over these retail prices is incredibly important, because when your product is more accessible, that means that you can actually get into the hands of more consumers. Just to understand that a non-vertically integrated retail business, they make their money on markups, whereas a vertically integrated business is making money all along the way. So they don't have to squeeze every little bit of juice out of that retail orange. They can, make the product a little bit more accessible to the retail consumer. And the last benefit I want to talk about for vertical integration is it's attractive to big investors. So if you're going for an M&A play with your cannabis business, or a merger and acquisition play, then vertical integration is attractive to the biggest players in the game. Bigger investors want plug-and-play models that are proven to work, that are proven to be profitable, and this typically leads them to look at vertically integrated cannabis-based businesses, and they offer premiums for these businesses. It's a headache to build a cannabis supply chain piece by piece, having to integrate teams and systems and financials and licensing headaches and everything that comes along with business combinations. So it's incredibly important that you have excellent cost tracking and revenue attribution systems, so you and your business partners can show the profitability of your business overall, each segment or profit center, and where the true value lies in your business, and what can be juiced up later down the line so that this potential investor could actually move in and grow this business, and they know where to grow this business and what's the most profitable part of it. Make it a layup for the investors to see the value, and you can have a slam dunk business transaction. So now that you understand the benefits of vertical integration, I want to talk about, conversely, the benefits of specialization, because not everybody's going to want to move into vertical integration or is even allowed to. So let's talk about specialization and how that can be beneficial. So first, specialization provides a comparative advantage for you compared to vertically integrated businesses in most cases. So what this means is that you can typically produce a product or provide a service more efficiently and at a lower cost to competitors. For example, if you specialize in cultivation, you can usually get a cheaper cost per pound as a specialized business compared to a vertically integrated business. Or you have better margins at retail because of your dialed-in operations. Or maybe you have better yields in manufacturing. When you focus, you can leverage economies of scale to get better performance results and a higher profit margin in just that one vertical that you are best at or relatively the best at. Now, this is not always true, but in most cases, you do get a comparative advantage faster than a vertically integrated business. Which leads me to my next point, that specialization in specialized businesses potentially and usually have a better ROI or return on investment. As I brought up earlier, vertical integration is very, very capital intensive, and it's quite easy to have waste with a budget that big and a vision so large. And ROI is directly correlated to how much money you put into an investment. So with specialization, you can deploy less cash to focus on just one vertical. And instead of juggling and learning 5 business lines, you can actually focus on crushing it financially in just that one vertical. This specialization will again allow you to leverage those economies of scale, capture bigger margins, and then generate cash flow to parlay into the acquisition of another line of business. But again, those bigger margins and bigger cash flow, when you deploy less capital, create a bigger ROI. So less cash outlay, better performance means better returns for your investors. And if that's you, that means better returns for you, the business owner. And lastly, specialized businesses are strategic acquisition targets. Now, any business has the potential to be acquired, whether vertically integrated or specialized. It just depends on who your suitor will actually be. Now, with cannabis being federally illegal, companies need to have a footprint in each state they want to compete in. And that footprint needs to extend to all parts of the supply chain. So yes, cultivators, manufacturers, and distributors can be nice targets to acquire, especially when you see how the actual local industry is shaking out. But it's well understood that retail operations have huge control over customers and access to those customers. So big retailers that are specialized, that have high revenues and large consumer and customer bases are attractive targets to multi-state operators. When you're going into specialization with the intent of being acquired, what you need to think about and look at is understand the relative amount of licenses in a market and see which parts of the business could potentially be the most valuable because they're the most scarce, but this also has to be within your exit time horizon. For example, if you see within a specific market that retail licenses are not going to be opened up for another 3 years and your exit horizon is within the next 24 months, all right, it looks like retail may be more scarce, it may be more valuable. Whereas if they're going to be constantly letting out these cultivation licenses, that may not be the best move. But it's all relative to your market and how things are changing. So there's no steadfast rule on this. It's just understanding your local market because again, cannabis is federally illegal. If a company wants a footprint in your state, they have to buy a company in your vertical in that state. So just be thoughtful around what is the supply of licenses, what is the competition for these types of businesses. And to build on that, you also need to pair up your skill set to which vertical you choose. Again, if you can't keep a houseplant alive, then you probably shouldn't go into cultivation. Do what you're going to be the best at, and additionally look at what could be the most valuable. If you're the best cultivator and there are lots of cultivators, you could still rise to the top of that cultivation pack. So just be thoughtful, skill and scarcity. So now that you understand what vertical integration is, the benefits of it, and comparing that to specialization, I want to talk about the profitability analysis of a vertically integrated cannabis business. So understand this is going to be an incredibly simplified overview of a very complex and nuanced process of analysis. Now, most companies look at consolidated statements and just know if more money is coming in than is going out, or very few, sophisticated businesses and operations take the time to break down each profit center to know where the inefficiencies are. But that's what every vertically integrated cannabis-based business should do. You need to know where the inefficiencies are so you can tune that machine up and make more money. So before we even start the profitability analysis, you need to understand that systems are incredibly necessary to make this analysis as accurate as possible. You may not think this, but cannabis companies are almost tech companies to a certain extent paired with a product, and they need to be incredibly diligent about implementing systems to track every aspect of their business. The quality and detail of your accounting and tracking systems directly impacts the quality of the data that you can analyze. You'll need a detailed chart of accounts, the ability to code every expense to different cost centers with incredible minute detail, because it's important to separate out direct and indirect costs for this analysis, but also for IRC 280E. So before you can assess profitability for each business unit or each profit center, you need to implement proper systems first. So once those systems are implemented and they're trued up and properly being used, we can then start with the retail profitability. You always start by looking at the retail level. Now, this is typically the easiest part to analyze because most companies have this data readily available through their POS system and invoices that they use to purchase products from external third parties as well as from their other business units. So this is where we start. So you start by pulling in all of your POS data and then assign revenues and expenses to each of your dispensaries if you have multiple dispensaries, or just to that one if you only have one. Now, you need to account for taxes as well because they are the steepest at this retail level. And if you're not pricing your products properly, you can actually run negative within your business. So once you've determined retail profitability, the next part is to pull apart each vertical or each profit center. And this is where it can get really, really complicated and messy. But you have to start again with that retail profitability to see, is the business even profitable overall, because all business units flow into retail, unless you're doing a ton of wholesale, but that's not typically the case. So if retail is profitable, all right, cool. That means that most of the business units are probably profitable, or one of the business units is offsetting a loss in the other. So again, we need to break those apart. So the next step, again, is analyzing each profit center. So each vertical is considered a profit center in your business, such as cultivation, the processing lab, and your kitchen for edibles. Now, each one of these has revenue and expenses. Consider them their own business. So first, you'll need to analyze the sales at your retail store or stores. We did this in the previous step, but we need to assign each of these revenues to a different cost center or profit center in the business. And as you know, each product came from a certain line of business. So again, you want to assign sales to each of those profit centers. For example, if you sold 1,000 cartridges at retail for $50 each, then that is $50,000 of sales that goes to the manufacturing lab profit center. So you need to do this for each product that you sell that is your own. Now, obviously, you're going to need to do this for third-party products, and that breaks out into its own profit center. There's going to be revenues for third-party products that you sell that you don't manufacture, as well as costs assigned to those. So break out the revenues for each of those products that are assigned and come from each profit center. Now, once you're able to assign sales to each profit center, you then need to allocate expenses, and this is the most complex part of the profitability analysis. Now, direct costs, they're easy to assign, but indirect is where it can get actually quite complicated because these are expenses that are shared by the entire organization. Now, we will touch on indirect expenses in a moment, but let's just stick to your direct costs, which are your cost of goods sold expenses, so that we can get to your gross margins of your business. And this is where the detailed part comes in. You're going to need to perform an incredibly detailed costing analysis for each product. These are the numbers that will be used for cost of goods for each profit center. You need to understand what it costs to create a pound of cannabis or a gram of oil or one small gummy or 100 pack of gummies for your edibles. And this again is where the detailed expense coding in software really comes into play. And you'll also need to have the cost, but you'll also need to have the yields dialed in so you know that the flow of products from one vertical to the next and how that translates into costs for other units. For example, you need to know the cost to produce a pound of flour, but then also understand how much that yields in terms of grams of oil, and then how that actually converts into the number of grams of oil that goes into a package of gummies, right? There's a lot of very detailed flow of product in a vertically integrated cannabis business. If those systems are not tracked, you cannot do a detailed cost analysis for the products, and essentially you're guessing at this. Again, this is a very simplified walkthrough that I'm talking about, but in this step is where it truly pays off to have that data captured, because going back and estimating will only get you an estimate and not exact outputs. So having your systems implemented from the beginning or as early as possible is important and critical to getting this costing analysis correct. So once you have those direct costs implemented, you can now understand what your cost of goods sold is, and then you have your sales, your direct expenses, which are again the cost of goods sold. You can now see the gross profit and loss and gross margins of each profit center. Now this gross margin is what you're going to use to cover all your overhead expenses for the business, things like rent and payroll. So let's dig into that. So the next step is going to be allocating your indirect expenses. And some of these are easy to trace back to each profit center, such again as rent, utilities, and payroll. But other direct expenses such as advertising and marketing, insurance, professional services, executive salaries, you need to have a reasonable methodology to allocate those properly to each business center or each profit center. So there are a few ways to do these allocations, but we typically do it based on the relative size of total revenue for the entire business. So if a cultivation brings in 25% of the total revenue for the business, it absorbs 25% of the overhead indirect costs. Now, after you and your external accounting team have plowed through creating this analysis of your vertically integrated cannabis business, you can then see the margins for each of those profit centers. What is the cultivation profit margin? What is the lab profit margin? What is the edible kitchen profit margin? Now, this will help you decide which lines of business to keep and which ones to cut or to scale back or even to scale up. But cutting is not as easy as just looking at profitability. You need to look at the synergies between between lines of business. For example, having an edible kitchen in the back of your dispensary or your cultivation operation can actually offset some of the rent costs for that space that would have been unnecessary or too much of a burden for that dispensary or that cultivation. And if you were to quote unquote cut the unprofitable kitchen, you would then make your dispensary or your cultivation unprofitable. So it's important not to rely just on the numbers, but also understanding how the lines of business interact with each other, their capacities, and how their costs and sales relate to each other. Now, another example is related to capacities. Maybe it's simply a scaling issue within the kitchen that's making it unprofitable. It's not hitting full capacity, but if we hit that threshold, it could be profitable, that max capacity threshold. So make a plan on how to optimize your business to bring up those production numbers and execute against that plan to make the kitchen profitable so it can, quote unquote, stand on its own in profitability. Now, I know that was a lot of gabbing about numbers, but let's just look at a visual example of how to do a profitability analysis for a vertically integrated cannabis-based business. So what you see on the screen here is a vertically integrated cannabis-based business. It has different lines of business. You have the manufacturing, the kitchen, which is for the edibles, the cultivation, and then buying third-party products, as well as corporate overhead. Everyone's going to have some type of headquarters that has to happen, and that last column is the aggregate total consolidated business. Now, you don't see retail on here because retail is selling all of the products that come from all the other verticals. So let's dig in. That revenue line, the first line, where you see manufacturing is $150,000 in revenue, kitchen is $40,000, cultivation is $100,000, and third-party products is $800,000. All those revenues come in from the retail operation. That's why you don't see the retail operation on here. Then those cost of goods sold, the second line down, is where you get that detailed cost analysis for each product. So when you bring in those revenue numbers, say for example, you have a revenue of $150,000 in the manufacturing. Now maybe that was 1,500 $100 cartridges, 1 gram cartridges that are super good. Now you need to understand the number of cartridges that actually drove that $150,000 in sales. So when we say it was 1,500 cartridges, we know to assign the cost of goods sold as $55,000. Okay, you do that for each line of business, you add that as the aggregate at the end, then we're good. We can move down to the third line, which is your gross profit. Okay, so you start to see, all right, how much money are we actually profiting from each line of business to help offset overhead costs for each vertical as well as for that corporate side of the business. From there, we look at profit margins. This helps you to understand which area of the business is the most profitable on just the pure product. And this brings us to the next line, which is other expenses. And these are just miscellaneous expenses that you can directly attribute to the manufacturing, kitchen, cultivation, or third-party products. And then you see the big number there is $320,000 in corporate overhead. It's things like salaries, rent, things of that nature. Now, we need to allocate those expenses later, and I'll show you how that ties all together. Now, you have that net operating income, just reducing those expenses and backing them out of that gross profit. But it brings us down to the next line here, which is the corporate allocation percentage. Now, as I said earlier, how do you actually allocate those $320,000 in corporate overhead? We typically do this by the gross revenue and then allocate those corporate expenses by their relative percentage of gross revenue. So when you look at, for an example here in manufacturing, $150,000 divided by that column on the right, $1,090,000, that's going to be 13.8%. So you multiply that 13.8% by the $320,000 in corporate overhead, that'll get you to $44,037. Now, you just do that for each line of business, you bring that down, and you'll see the divisional net profit before tax. Then over to the right, you'll be able to see the total for the entire consolidated business. Now, things to understand is that those other expenses need to tie down to the corporate allocation, those two yellow boxes, as well as the net operating income needs to tie from those two orange boxes. So again, this is a very simplified example. There are more nuanced calculations for each line of business and things of that nature, but just wanted to show just a very basic example of how to do a profitability analysis of a vertically integrated cannabis-based business. Now, we covered a lot of ground here, but hopefully this video has brought you some value to understand what vertically integrated cannabis businesses are, their benefits, comparing them to specialized cannabis-based businesses, as well as walking through a basic profitability analysis of these vertically integrated cannabis-based businesses. Now, if you need help with analyzing your vertically integrated business or specialized cannabis-based business, then please reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. Over the past few years, we've done these specific analyses for vertically integrated cannabis businesses as well as our specialized cannabis business clients. Having this knowledge is incredibly powerful in how to steer your business through the treacherous waters of the cannabis industry. Not having this information and not understanding the profitability of your business month after month can really be like flying with blinders on or having no vision of where you're actually going, and then you crash into a mountain or you hit an iceberg in the ocean. You don't want to do that because it can lead to your business going out of business, and that's not something you want. But if you have this information and you have historical information and you can show the trajectory of your business, you can demand a higher price if you become acquired or sell your business to somebody else. So again, if you need help with analyzing your vertically integrated cannabis-based business or your specialized cannabis business, please reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. Have a great day, and we'll talk to you soon.